Here is a question almost nobody asks: what happens when a Eurozone bank walks up to the European Central Bank for cash, and the loans it offers as security were made to a heavy polluter? As of today, Thursday the 6th of August 2026, that answer is being rewritten. The ECB is extending what it calls its climate factor deeper into the Eurosystem collateral framework. Let me unpack that. When a bank borrows from its central bank, it must pledge assets as security. The ECB never counts those assets at full value. It applies a haircut, which is simply a deliberate discount, so it is protected if the asset sours. The climate factor makes that discount bigger when the underlying borrower carries higher climate risk. The turning point came on the 24th of July 2026, when the ECB announced the climate factor would be extended to certain credit claims where the debtor is a non-financial corporation. Credit claims are not exotic instruments. They are plain bank loans to ordinary companies. Until now, the climate factor bit only on corporate bonds pledged as collateral. So why widen it? Because bonds are a modest slice of what banks actually hand over. Credit claims are one of the biggest collateral categories in the whole Eurosystem. Applying a climate discount to bonds alone was a signal with very little force behind it. The ECB frames this as risk management, not activism. If climate exposure can erode a borrower's ability to repay, the collateral is genuinely worth less. The pain is not spread evenly. Utilities, materials, and transport are reported as facing the largest haircuts, and that follows directly from emissions intensity. Think coal-heavy power generation, cement, steel, and shipping. Here is the practical effect. A haircut is not a fine and nobody writes a check. It changes how much central bank liquidity a given loan can unlock. If a loan to a high-emission manufacturer raises less cash than an equivalent loan to a low-emission firm, that first loan quietly becomes less useful to hold. Bank treasury teams are already re-examining which borrowers sit in their collateral pools, and chasing emissions data on private companies that have never had to publish it before. Near term, expect two fights. The first is data. Listed bond issuers publish emissions figures. A mid-sized family manufacturer with a bank loan often does not, so scoring will lean on proxies and estimates, and that invites disputes over calibration. The second is ambition. Critics argued in early July that the climate factor is a genuinely good idea that deserves better implementation, because the coverage is narrow and the discounts are cautious. ECB research is now modeling several transition pathways that differ in how fast and how far emissions fall, which tells you the calibration is meant to tighten over time. Watch physical risk too. Southern Europe, particularly France and Spain, is absorbing severe climate impacts, and drought or flood exposure is the obvious next frontier. So here's what to hold on to. The ECB has just turned climate risk from a disclosure exercise into a funding cost. It is doing that through the plumbing of monetary policy rather than through a headline rule, which is precisely why it is easy to miss and hard to ignore. For banks, the greenness of a loan book now has a measurable liquidity value. For companies, especially in energy, heavy industry, and transport, your carbon profile has become part of your credit story. And for everyone else, this is the clearest sign yet that central banks intend to price the transition rather than merely talk about it. Small technical change, very large direction of travel.